Hello, ladies and gentlemen. Welcome to our webinar today. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we will have a look at a few key points that we all need to remember. And most of all, it is when we should actually avoid the market. Now, those particular points that we will talk about, they're quite short compared to our previous webinars. Still, the importance should not be overlooked. First, let's mention one more time for those that were not here this week's Wednesday webinar. We were having a brief look over the structure of the trading plan itself as we were going through the whole process of developing from the beginning up until this point. We saw what is the correct way to develop a trading plan by following by far the basic structure of itself. Today, however, as I mentioned of this session, it should never be overlooked. Basically, we all know so far how to enter the market, how to exit it, what we should do prior and after the market itself. But what we also need to know is what to look for when we should stay away from the market. So there are conditions, ladies and gentlemen, on the market that it's better to not trade at all instead of risking some of your balance, of your past profits, so on and so forth. One of those ways that we can actually protect ourselves is by simply staying away from the ranging market. Why I'm saying that, it's for majority of the traders, whether you're a basic trader just walking in into the market or you're an advanced trader as well, you know that within the range, within the boundaries of this ranging market, there are different rules that should be always taken into consideration and of course kept without question if of course we want to benefit with the ranging market. It's a bit of a tough call to trade a ranging market, as well as you never actually know when it's going to break through those boundaries. This is by far the beginner's strategy, and it is actually to trade only the trend or a directional trend. It works better when of course the market is trending, simply because if the market is trending, then your profit targets are more likely to get hit as long as you're trading in that direction. There is the advantage to be able, of course, to identify when the market is trending and when it is ranging, because you can avoid this particular ranging market. And the conditions are to reduce the likelihood of unprofitable trades by waiting for a price breakout. So what you have to keep in mind is that there are a variety of different instruments in our platforms or any other platform. So you don't need to focus on only one instrument, rather than if you're actually a basic trader, or, you know, as I mentioned, you are just hitting the first few levels of the market. It's better to focus on one or maximum 2-3 instruments, so you can actually get the hang of it, see how the market is working, what you have to look for when the price is changing, and what is actually driving the price. So when you actually advance from intermediate to a higher level of trading expert, then you can actually start trading those ranging markets. Simply, I'm also trading the ranging market, one of the most beneficial ways on the market as well. However, I'm not saying that it doesn't come with a cost. It is a bit more frustrating, strict following the rules of the ranging market, always with a tight stop loss. Basically, what we mean by ranging market, for those that doesn't know that, is that a range has an upper and lower boundary. An effective method of determining a price range is to identify the upper and lower boundary and of course place support and resistance levels at those points. Have a look at this chart that I've actually made a simple screenshot. This is the daily gold chart. As you can see here, this is the range that we speak about, the upper and the lower boundary. I'm not really going to focus that much on this particular sideways market. Simply, I'm showing for those that have no idea so they can navigate better. So a hint to see if the market is ranging is to look at the particular candlestick formations. Now, it's very easy to find out when the market is ranging only by looking at the shadows. If the candlesticks are unusually short, smaller in real body, of course, and have long shadows, then this is a further indication that neither the buyers or the sellers are managing to gain momentum. And what you can see here is these long shadows left by the key levels of support and resistance. You can see, even if in this particular ranging market, you can see here, it's very small in number of days. However, it's still the same condition before it breaks through the upper level and the lower level here, so we can have a directional trend. It's still the same here in this chart. You can see for how long the price has been hovering between these two levels. Now this is far back in 2007. I had to scroll back to find something even tighter in a range instead of something larger in volume as we had in the previous one. But what's the most important here to understand is that the rules are very strict. You have to use several different indicators that signal you overbought and oversold conditions, one fast and one slow, and of course always to obey the rules of a broken boundary, which is either the upper or the lower one, and of course confirmed by a few closings. That's pretty much it. Now another thing that I would like to take a look at here, especially on building profits by identifying market problems within ourselves, you know, from a technical or fundamental standpoint, and taking risk at the most opportune time. So you see, it is one of the few pursuits in which consistent losing is the natural component of a winning equation, or a constantly profitable account. In fact, there are pretty good trading strategies that produce many more losses than profits, many more lost trades in numbers than profitable trades in numbers, but at the end of the month, or however you want to measure it, still we achieve growth within our accounts because the average profit far exceeds the average loss. Most new traders enter the market and trade emotionally, and of course tend to lose money in time, believing they will find a perfect profit-making system and avoid the pain of losing positions. Of course, this is pretty much close to impossible given the complexity of the market movement, as well as the competition among traders and institutions that categorizes our modern environment in which we're trading today, and this is the electronic trading. The vulnerability, of course, becomes a secondary obstacle to the new traders as they learn how difficult it is to take money out of the market on a consistent basis. So, ladies and gentlemen, one of the most important points here is to overcome your losses. If you cannot overcome your losses, you have to stay away from a risky market. when we have major announcements, or when we have some inflation data coming into the economic calendar, something that can actually break the rules of your own technical trading system, to which you probably obey without a question, and you're following your trading plan by the book. This is one of the things. The other thing is to prosper in trading. The emotional burden of loss needs to be managed very strictly. This requires, of course, a few steps. One of it is to understand that losing money is perfectly normal on the path of profitability. You cannot win all trades. And of course, taking time to examine the consequence and to examine the negative feelings about money, wealth, and risk is also an important step. You have to take this as a general job, that at the end of the month you're getting your paycheck. So you have to be emotionless when making and losing money, because there is no trader out there that can win all positions in his life of trading. Another very important point here to overcome your losses is managing the loss side of the particular equation through a proactive trading plan and strategy. That would mean that you have to trust your trading plan and your strategy. If it starts playing out of the rules, of course, that means something has been shifted on the market. Fundamental says you don't have shifting every day. So then you have to readjust these trading conditions according to the market of today in order for you to start trusting these systems again. And of course, this is something that you will see in the future, how you will develop the strategy that suits you best, the trading plan that goes along with it. And of course, if something doesn't play out as normal, or as your scenario has actually decided, that means that something needs to be tweaked just a bit so you can keep going in the right direction. That makes us to go through some of the most important market scenarios. Some of them are extremely dangerous, let's say, let's put it this way. Of course, inside there you will find, and we will discuss a few points where we should stay away if we don't feel comfortable when trading, and when should we quit the market, that there is something going on right now that we don't understand, and we better cut our trading day until this point so we can go back and see what we've done wrong, instead of making that mistake tomorrow again, or even doubling those, tripling, making a 10 times bigger mistake today, and eventually to result within a very, very heavy loss over our accounts. And this is just a very light word that I'm using, because in most cases only one trade can wipe your accounts. Of course, there are many ways, as we mentioned, to lose money in the financial markets, and if you trade long enough, you will get to know all of these ways imminently. Unfortunately, experience and awareness allows traders to avoid traps that other people faces, that other traders face. So the most effective step you can take is to stay out of trouble by recognizing a few market scenarios that place you at most risk. So you see, there is one of those that you have a bad market, so it's just not good for you to trade it today, maybe tomorrow as well. This is an attractive pattern, or some kind of an understanding that how to overcome a dangerous market environment. So when this happens, you just have to stay away from the market. Just get away from it. This could be, let's say, conflicting trends, changing directions really fast. This could be small liquidity, or let's say any announcements that are so mixed that very little traders out there understand, and the market is extremely choppy, and there is no need for you to be there, because the risk-reward ratio is inappropriate, let's say. This is also another way to look at it. Now, of course, market conditions that traders are picking regularly in a very typical for the daytime, should there be. Okay, trends, for example, tend to continue after, let's say, sideways direction, 15 up to 20 maybe. Sometimes the largest number that I've seen is about 30% of the time. Most of the time, the trends are actually getting reversed. So this is what we saw in a gold chart. Let me just show it to you one more time. It's this one here. That's daily chart. You can see a strong downtrend here. After a sideways, instead of continuing down, it reverses with 100%. Because what is the general rule for trends? It's more likely to continue instead of reverse, the general rule. However, there is also another market condition that traders should always have in mind, that is very tight with bad timing, should we say. So always we have to pay attention to buy and sell in multiple time frames, because all good trades still lose money if you are playing in the wrong time. So let's say you have a confirmation signal that you have to buy, let's say, the euro versus the dollar, but the move is already exhausted. However, on the larger time frame, there is still more to go. But before it actually continues its route north, it has to consolidate for some time to gain momentum one more time, because the sharper the volatility jumps, the faster it will fall. So it has to be a steady 45 degrees trend, and the volatility should be also steady, pretty much to get a good, perfect trend. But most of the times, especially after announcements, we see a very large candlestick occurs, like sometimes 100 pips in distance on 1 hour, even on 4-hour charts. This is something very often that you can see in today's market. This is the so-called candlestick and 4-hour time frame trend that it continues only for 4 hours. After that, it retraces at least 50% before it starts picking up again. So bad timing means that when you lose and when you lose the move, when you are not able to enter at the right time, right after the announcement itself, and you were late for like 10-15 minutes, the moves are already over. So you better wait for a better time, or should we say, stay away from the market for a better timing. That means you might need to wait for another 15 minutes, or another hour, or another 4 hours, or maybe it would be more appropriate to enter the market tomorrow. Now, what happened with yesterday's gold move? Through the night, on the signals that I'm sending to some of you guys, most of you, or just some of you that are not trading with us at the stage, probably don't receive it yet. But what happened is we saw that gold is trying to push higher. Okay, let's have a look at this chart one more time. Okay, gold was trying to push higher for the past 3 days. However, that was yesterday's move. You see this candlestick, this is today. And what happened is that we were waiting to see the job data after the Fed minutes from Wednesday. So after the job data yesterday, gold moved with about $23 plus the Asian session as well. $23 going through all of our three targets. But what is important here to understand is that we had to have our good timing. So we cannot enter the market prior to some key data, because what would happen if the job data was good? Then gold would most probably decline two times the size, most definitely, because as we already know, markets are falling faster than they're rising. And of course, we were in a very key resistance level here. You can see around the 1144.45. That was something that we had to have as a confirmation with a 4-hour close, so we can get this. This is a daily chart, so we can have a better perspective on the past price, especially on this case here. You can see how this sideways direction consolidates very tightly. That means it's a key support resistance area, and that's why we need to be sure that it's going to be sustained. And you can see this long shadow here. This is as far as it went throughout the Asian session, and then it dropped down. So you see that's almost 50% of the previous move. That's why I'm saying that if you miss this one, then you have to wait until the price retraces 33 to 55%. It's relative to the market conditions, and today we have lack of any kind of information. So we saw the market dropping down to our initial starting point at 1148, 47.48. So then we had the chance to buy one more time and to hit our first target. So now we have another profitable position, but that's because we waited. And what I did with my trading day yesterday was to see my first target hit, then my trading day was over. I rarely leave positions overnight, especially in today's China conditions and its economy. You can see how tough the things are right now there, and it can actually affect the gold price both ways, basically. And of course, we saw bad numbers throughout the manufacturing data over the night, and the price shot up with another $10. Basically, that's what we see. So I don't know what kind of numbers I'll see throughout the night. That's why I don't leave any positions open, or if I cash it in, I don't open new ones. Even if I know that the price will go higher, I don't leave anything to the chances. So instead of just throwing a dice, you better see what the actual number says and then enter clearly. So even if today we had only one target with about $7 of profit on the gold, still on one lot this is $700. But what if some guys are trading with 10 lots? That's 7,000, or even 100 lots. That's 70,000. So you see, it depends on your equity, but it's still the same profit. Nevertheless, let's have a look at another market scenario here that we might face. This was a very good example with yesterday's trade, right on the point of today's topic. There is something that involves bad trades, bad stop loss, bad information that we will take a look at. Those are another 3 points that we have to take a look at. That makes them total of 5 market conditions, market scenarios, should we put it, that are most important for you guys to remember. There are minors that stand in between the lines of those, which you will eventually see for yourself within your experience on the market. But right now is the time to take a look at the bad trades and how you can be a very good trader, a great trader indeed, and still take ridiculous positions that are of course destined for failure. Even I'm making these mistakes every day, at least once. After all, we're just human beings. We tend to make mistakes all the times. The importance of it is to learn from it, from those mistakes. The unfortunate fact is that we learn from the mistakes of other traders instead of ours, but that's also something, as we call, an experience, not necessarily a bad one, but just experience. So there is a common, let's say, a saying among traders that when this happens, when you have a bad trade, especially with traders who have, let's say, already paid their dues, they're suffering on the market. In most cases, the individual traders feel a little smarter than the market, and of course expect price action to bend to their will. Now, how exactly is that going to happen? First of all, you don't have a crystal ball, or even if you do, we don't really believe in magic, because trading is not magic, it's just math. Well, we all go through this particular ego problem all together, and from time to time. Okay, even I do that, but it's never too late to get out of this particular stupid trade. So once for me it happened that a curious case, actually. I was trying to open a position, all right, just a small position, but then it's simply because I wanted to catch the bigger move, because I knew what kind of non-farm payrolls data will be. It was quite obvious, because it didn't really matter whether it's above or below expectations, but the number itself, which was quite clear. If you make some research, you can pretty much see what the average movement is, and you can guess of what the range would be. And in that case, it was beautiful. But then, even if I made the right decision then, in the heat of the market, I decided to close that position on a very small profit and then to reverse direction because the numbers were bad, but not out of this particular range that actually I calculated. And what happened, it was I knew that this position will be destined to fail. Still, I trusted that the market will bring me something better than I actually had so far by just holding it a few minutes longer, because I knew that the market will continue further down for a few minutes longer in order for me to get bigger profits, to scalp this position basically, and then open the one that it should be in the right direction and just leave it to go on for a couple hours. Well, what happened was a very fast spike to the downside. I was on a very good profit. Instead of closing that position and cashing in, I wanted to get more, so I went greedy, and then the market struck me back, so I lost that day. Still, I had the chance to make it up with a proper position, with a proper lot size throughout the trading day. It still ended up as a profitable one, but it went on my nerves because I lost it, and because I made that stupid mistake, which I know I should not have made. And this is something that we call bad trades. So everyone has it, whether it's from an ego standpoint that you believe that the market will bend on your will, which is not possible, or it's something else. It's different for every trader. Another thing is a very poorly placed stop loss that will shake you out of your perfectly good position. Now, this is something that I've faced with some of my traders here. It's a very common mistake to leave a small stop loss, even if it's the right direction that you want to trade, to leave a small stop loss in a volatile market. We spoke about this actually with volatility. We spoke about it yesterday in our structural overview of the trading plan. I still am going to mention it today. It is important to set 3 times at least bigger than your take profit, speaking of the stop loss, of course, when we have major announcements, because the volatility is very high at that point. And until the market cools down and the participants digest the information they just received, it will keep going that way. And you are at risk hitting your stop loss instead of your take profit. So stop loss needs to be placed outside of the market noise, while of course keeping the risk to a minimum. This is also something very important to remember. Instead, however, we come up with all sorts of independent criteria for our stop placement, and often locating a flat percentage price that's out of alignment with the dynamics of the traded particular instrument. So you see, the conditions that we actually setting our stop losses are different, whether it's it corresponds with your trading strategy or it corresponds with some support and resistance level that you have picked. But most of what's important is to take your stop loss out of the market noise, away from it, so you can actually avoid hit by this particular movement, the choppy trade, the market noise that we call it, before and after announcements. Because these particular moves actually occur mostly on large announcements. Speaking of nowadays, it was not like that long ago. It was mostly technically based on execution of large positions, like you know, securities swapping hands, or any central banks exchanging currencies. Still, that's pretty much because today's information availability to the masses became more and more easier to find. So, and also, of course, governments tend to be more transparent, so they say. But it is partially true, I would agree with that, because what we hear around news agencies, any kind of statements, they are quite open. That doesn't necessarily mean that you will understand what they're saying if you're not tuned to their music. So to speak, if you're listening to some politicians, let's say, they say so many things, and at the end they say nothing. So how do we actually understand what they mean? Well, you have to be either a politician or at least familiar with their way of addressing the masses, and being, of course, also aware that politicians are usually very, you know, how to say, very easygoing on what they're trying to say, and even they're saying pretty much nothing. But that's something else. Another thing is, in connection to that, is the information that you're getting, whether it's a valid or solid, true or bad information. And here we come to our last scenario, the bad information. Traders, of course, always rely on information from numerous sources to analyze prospective positions and, of course, take risk. This set is another dangerous scenario. First, we enter a trade before reviewing all the data that point out that we need to justify that particular exposure. So you see, we have to look at the news first to see if there is something that is not going to stop us there. This rule, this scenario can go straight on our pre-market preparation in our trading plan. And that's the pre-trade, if you remember from our structural graphic from yesterday. Second, we enter trades when we review information which actually is interpreted by the wrong way. So this is also called bad information. What you need to do, ladies and gentlemen, is to always refresh your data gathering by pausing out all of your sources and examining how well each works before, of course, adding them back into your workflow one at a time. So you need to have a trusted source. You cannot always, okay, let's, I'm not going to mention any names, you know, it's not really allowed, first of all. Second, it's not professional. Let's say some social medias, all right, they have, you know, messages like posts that every different person makes. Now, how valid and how true a particular statement is by a person you have never heard before, or someone that never actually proved to you as a news agency that it's large enough, or let's say, you know, worth trusted with the information that it provides you. This is what you need in order to be always kept in time and in line with what is happening. The bottom line, ladies and gentlemen, here is that managing the loss in trading will instantly benefit your bottom line when you draw the line down at the end of the month. While, of course, a reliable strategy, healthy psychology, and effective trading plan all work to build profits. Recognizing the most important and dangerous market scenarios can save a lot of money in avoidable losses. And this will improve your confidence and setting the stage for long-term success. First of all, this session today, ladies and gentlemen, is not by preaching you something out that I believe. It's pretty much the truth. So what you see in front of you, all four of these rules here, are everything that we need to do to keep our trading plan healthy, trustworthy, and ourselves in line with expectations. Therefore, what we will do next time, 2 sessions, next Wednesday and next Friday, we will take all in one, all the rules, all the trading plan, and we'll just drop it in the live chart and see how it works. So basically what I will do here is just use by the very simple strategies, the very simple setup, and the basic structure of our plan for you to observe exactly what is the use of what we made so far for the past 2 months. And if you like it, you're welcome to use it. Of course, you can always amend something that you can you know, incorporate much well, like different trading strategy, multiple stop loss and take profits if you're trading the range, and you can just build around or above and below this trading plan and its structure to expand it as much as you need to gather everything important for you. But the basics is only one. Well, until next time, thank you very much for joining us. We will throw everything all in one in our live chart next Wednesday. So be here, and thank you for joining. See you next time. Bye-bye.